This is Professor Hazara, and this is the fourth video on the basics of revenue recognition. This particular video is going to be on long-term contracts. These are usually contracts that have to do when somebody's building something, usually a building. It can be other things, but usually it's a big thing, like a building which takes maybe a year and a half. That's why they're called long-term contracts to complete. And one aspect of these contracts is they're usually fixed price. So if a contract is fixed at 10 million, contractors got to come in below but they have to, their costs have to be below 10 million to make profit. And if if their costs are over 10 million, well, they're going to lose money. Okay. And so uh, there's two ways to account for these types of contracts. The first one is called percentage completion, and we're going to basically use this method all the way through because this is the method really which people use. And there's another one called completed contract, which is basically the same thing, but you don't recognize revenue until the end of the contract. With percentage of completion, as the name implies, you recognize revenue based on the percentage of the completion of the project at a certain point in time. Whereas completed contract method is you wait till the end and then recognize all the revenue then. Okay, so the best thing to do is to go through an example of percentage of completion. And this topic is important because there has tended to be simulations on the CPA exam of percentage of completion. So that's why I'm going through the basics here in some detail. I'm going to have one or two reinforcement exercises on percentage completion on Brightspace. They'll be pretty simple, but I do want you to at least go through the process so that if you take your Becker CPA review or whatever, and you see a problem like this, you understand what's going on. Okay, so we're building a building. Percentage completion method recognizes revenue during the completion period of the project. That means that if a project takes 2 years to complete, you're going to recognize revenue over those 2 years. Okay, this method is thought to comply with the matching principle, and that's you're incurring costs, you're incurring revenue on not all through. I don't know if it's evenly, but you're incurring them, and basically as you complete the project, you recognize both the costs and the revenues. So you're matching costs with revenue. That is preferred over the completed contract method, which recognizes revenue time when the project is completed. So we're going to stick to percentage completion. Okay, now the percentage completion, it's not that complicated, but the first time, one or two times you see it, it's kind of different. So I'm going to try to go through this fairly slowly, at least so you can stop the video sometimes and see what I say about specific counts. Okay, so the ABC Construction Company signed a contract to construct a building for Gotham City. Okay, the fixed price of the contract is 10 million. So if they come in, their costs are under 10 million, they have a gross profit. They come in over 10 million, they have a loss because the fixed price contract price is fixed. The building will take 18 months to build and will be constructed during 2025, the last 3 months of 2025, 2026, the entire year, first 3 months of 2027. In the following table, and will always be given the data in these tables. There is no choice. You need to have the cost data and some data on revenue and fixed price and all that. Okay, the following table summarizes the actual costs that were incurred during the project and the costs that were estimated to complete the project. Please note that the estimates to complete change over time. Okay, so this table looks forward and also it's kind of a forward-looking table, and it also kind of shows how not only the actual costs were incurred, but how maybe the engineers changed their estimates as the job progressed. Okay, so you got 3 years. Actual costs incurred during the year, 2 million during 2025. Keep in mind this is a $10 million contract. The revenue. 4.6 million in 2026, and that makes sense because most of the construction takes place in 2026, and 2,100,000 in 2027. Okay, actual costs incurred in prior years, 0 in 2025 because it has to be 0 because it didn't start until 2025. Then 2 million in 2026. So from a 2026 perspective, the costs from prior years were 2 million. And the easiest way to think of this is that this would equal the actual costs incurred to date from the previous year. Okay, so you can look at this, and this number moves up there. Okay, and then so as of 2026, the actual costs incurred during the year were 4,600,000, and the cost incurred in previous years were from 2025 to 2 million. So actual costs incurred to date are 6,600,000, and then in 2027 they incurred 2,100,000, and this number here is passed up. Let's see, passed up from there because in two previous years you had incurred 2,046,000. So in previous years they had incurred 6,600,000. So at the end of the contract, the actual costs incurred to date are 8,700,000. Now, these are sort of progress reports. They paid this the last 3 months of 2025. They paid this during all of 2026 and 2027. They paid first 3 months of 2027. They paid 2,100,000. These were the actual costs from the previous year. So these are your actual costs as they build. However, when you use percentage of completion, you have to estimate how many costs are left to complete the project, and that's because there's a certain fact that there's certain costs you have already incurred, and then you have to estimate what the total project will cost you, and so you need to know the cost that you think it will take to complete the project, because it is called percentage of completion, and the percentage of completion is based on the percentage of costs that have been incurred. Okay, so we'll do that calculation in a second. So as of 2025, here's what they're thinking. They're thinking that, well, they've already incurred $2 million. Then the engineers estimate the cost to complete. And so as of the end of 2025, the engineers think that that the total cost will be 8,500,000, which really means that they think that the project is going to have a 10 million. It's going to have a $1,500,000 profit, $10 million fixed cost less $8,500,000 total cost. That's what they're thinking. Now the fact is the $2 million is a fact. This is the 6,500,000 is what they think they're going to pay over the next 2 years or to finish this project. Okay, then we get into the next year. By the end of this year, they have for 2026 for this year, for 2026, they incur 4,600,000. They've already incurred 2 million. So they think, no, they don't think. They know they have incurred to date 6,600,000, and they're getting closer to the end of the project. And they think that the end of the project, to get to the end of the project, it'll take another 2 million. Now that's a guess, because the word estimate is used here. Estimated cost to complete. Of course, they're just 3 months away. By the end of 2026, they're just 3 months away from finishing the project. So they think the estimated cost of the project is going to be 8,600,000 is what they're going to think. Now they get to 2027, and in a sense, you'll see that the total costs have been gone up by $100,000 right there. And that's because in 2027, they actually incur 2,100,000, which is more than what they thought they would incur, which was 2 million. Okay, and then they take what they actually incurred. By 2027, the project is finished. They had incurred 2.1 million in 2027. In previous years, in the previous 2 years, they had incurred 6,600,000. So the total costs to date at the end of the project are 8,700,000, and that means they actually made a gross profit of 1,300,000, which we'll look at the end. But it's basically 10 million less total cost of 8,700,000. So this is I'm going to sort of box this in here. This is really the total cost summary of the project. So I'm going to go ahead and see if I can't just sort of box this in as a separate sort of section here. Okay, now the next table, in a sense, this is cash flows, basically. Billings and cash flows. There's always a table. These are given to you too. These are really billings and cash flows. Basically these are bills that you send to Gotham City in this case. This is a contractor, and they're going to send, these are bills that they send to Gotham City as the project is completed. They'll send a partial bill another bill, and another bill. But notice that these bills add up to, and here's a note I put here. Notice the billings and cash collections total 10 million. That's true for the billings, and these are the cash collections. Because this is a fixed price contract, they're incurring all these costs. So as they incur the costs, the city has to start paying, or they're going to come to close to $8.5 million in costs. So the city has to pay as you go just to let them work on the project without going bankrupt. Okay, so these are billings by the contractor to the city during the year. They total 10 million. They come to that $10 million fixed price contract. And these are the cash collections from the city during the year. Notice these total 10 million too. So this is just accounts receivable and the cash is collected receivables. Okay, now here are the four things that we're going to ask you to do on percentage of completion. The first thing is you need to compute, and this is really the key number, the percentage of completion of the project based on costs. And what we're going to do is we're going to have $10 million total revenue. Rather than recognize it all at the end, we're going to take the $10 million and multiply it by the percentage of completion of the project. So if the project is 25% complete, we're going to recognize 10 million times 25% or 2.5 million, et cetera, et cetera, et cetera. So as the project progresses on a cost basis, the more complete it is and the more revenue you'll recognize. So we're going to start with that calculation. And based on the percentage of completion, so the first thing you have to do is compute the percentage of completion. And based on the percentage of completion, we're going to recognize revenue. What part of revenue, the $10 million revenue, and gross profit should be recognized each year. Okay, then we're going to prepare some journal entries, and there are some very different types of account here. And at the end, actually, this is something I added, the book doesn't have. We're going to show the relevant parts of some of the income statement, the balance sheet. Book talks about the balance sheet, but they don't really talk about the income statement. So I'll talk about a little bit about the income statement at the end. Okay, and as you move forward down the sheet, you'll see I have everything kind of set up here so that we'll just fill this in here basically. Okay, so calculation number one is based on these numbers here on the cost table. We have to compute the percentage of completion at the end of each year. Okay, so we come to 2025. And at 2025, by the end of 2025, we know that the actual costs that went into the project at the end of 2025 were $2 million. Okay, and so as of the end of 2025, the actual costs, both incurred in the year and to date, because of the first year, were $2 million. Now, the actual cost of the job is going to be, you incurred $2 million, you think it's going to take $6.5 million to finish. So from the 2025 vantage point, it's going to take, the whole job is going to take $8.5 million to complete. So your total estimated cost to complete the job are $85 million. And so at the end of 2025, you think you finished about 23.53% of the job. So 24% more or less. You're about a quarter, 25% of the way through the job. Okay, but that's just an estimate, given that the denominator here, this 8.5 million that I've put in here, is an estimate because it includes the costs you think you're going to incur in 2026, 2027. Okay, now you come to 2026, and in 2026, by the end of the year, actual cost to date, if the number is just up here, is 6.6 million. So I'm just going to go ahead and move that 6.6 million down to here. Okay, so the actual costs to date are 6.6 million, and as of you're almost finished. You're 3 months from finishing the job at the end of 2026. You think you're going to incur another 2 million, so you're getting near the end. So if you take the actual 6.6 plus the estimated cost to complete of 2 million, you think that the total cost for the job will be 8.6 million. So you think you're about 3/4 of the way done, which kind of makes sense, at the end of 2026. And then at the end of 2027, you'll notice that the actual costs incurred for 2027, the actual costs incurred to date are 8,700,000. There's no more cost to complete because it's finished. So your estimated costs incurred to date and the estimated total costs are the same thing. So we're just going to take, like we've been doing, the estimated costs incurred to date divided by the estimated cost to complete. Well, it's finished, so it's all done. Let's do this. Make sure you get this here. So you're 100% done. Okay, so those are your percentage completion. And it's all based on cost. But keep in mind that at least for 2025 and 2026, there's a sort of a guess in there because in these 2 years before completion, you have to guess as to what your cost will be from that date to finish the job. Okay, so that's calculation number one, estimated percentage completion based on costs. The next one is based on the percentage of completion based on costs. Let's estimate the revenue and gross profit that should be recognized each year. Okay, and this is a pretty easy calculation from the revenue perspective. The gross profit can be a little bit gross profit can be a little trickier here. Okay, so if you look at the revenue, this is a fixed price contract. Okay, so I don't know if I've put the fixed price in here. I already said it's $10 million. Let's go ahead and just note, well, we'll just put 10 million right here. So it's a fixed price contract. You're going to get 10 million, whether you like it or not. So you're going to get 10 million, and I'm going to copy that over. Okay, now the percentage of completion, we'll just move that down. Okay, so we'll move that down. So if we take the 10 million and multiply it by each percentage, what we're going to get is the total revenue. I'm going to put the word total here. We're going to get the total revenue to date that we should recognize. It's not the revenue for the year, it's the total revenue to date. Okay, so if we take this fixed price contract, we've got 10 million there times 20. We've got 10 million there times, just about 2 seconds. We've got 10 million times 24% more or less. So 2,352,000. Move it over. And we recognize those amounts. And of course, at the end of the contract, we will have recognized a $10 million total. Okay, now that is the total revenue that should be recognized to date. Okay, now what we have to do though is we have to subtract from that total revenue, or we'd be double counting the revenue that was recognized in previous years. So we have to subtract out, we have to take this revenue here and subtract out any revenue that was recognized in previous years. And that will give us the revenue that we should recognize at this point in time. Okay, so we know that from a 2025 perspective, that's zero because that was we didn't start the project until 225, so you could not have recognized revenue in previous years. So basically, this is going to be 22,300,000 minus that right there, which is zero. Okay, and then we come over here, and then in this column here, we have the revenue that should be recognized today at the end of 2026. It's about 76% complete. So on 10 million, which is about $7,600,000, which is the total revenue to date. But we have to recognize, and I'll put a minus here, that we recognized in the previous year, 2,352,941. Okay, so the revenue that we should recognize during this year is the 7 million total revenue on the contract that we should recognize over 2 years, 25 and 26. And we should subtract out that 2 million. Okay, so we should recognize this year 3,021,547 this year. Okay, and then in the final year, we come over here to the final year. The project is done, so we'll recognize $10 million in profit, okay? And we're going to recognize $10 million in profit, and but we have to, what am I saying, $10 in revenue, but we have to take out revenue that we recognized in previous years. And really, the easiest way to do it is just go, that the total revenue that you recognized in previous years was that number right there. It's either the sum of these two numbers, or you just take that number right there. So I'm just going to go ahead and go minus that number right there, $7 million. So the amount of revenue that you're going to recognize in the final year is that number right there. And notice I added these up. I added those numbers up. And notice that those numbers add up to $10 million, which makes sense. It's a $10 million contract. Okay, now, so we've got our revenue. Now what we've got to do is we've got to calculate the gross profit that we're going to recognize each year. And keep in mind, gross profit is just going to be your revenue less your costs incurred during the year. Okay, so your actual costs incurred during the year. So in going up here, let's see, up here, get the table. It's probably easier to do it here. It's going to be these numbers here. So what we're saying, these are actual costs. So, and in a sense, we're mixing an estimate of revenue with actual costs. So in the first year, we're going to recognize, based on an estimate of 23.53% complete, we're going to have revenue of $2,352,000 minus the $2 million in actual cost that we incurred during the year. So we are going to recognize the gross profit that we've got to recognize during the year is 2,352 plus a negative, which is $2 million. So we're going to recognize $352,941 in profit in that year. And we're going to do the same thing in the next 2 years. I think I can just copy this number over like this. Okay, so in the next year, we're recognizing revenue based on almost 0.75%, about 0.75% complete, but we had costs incurred during the year. Just a minute. Yeah, that's correct. Costs incurred during the year, which I pulled from right there. These two numbers here. Actual costs incurred were 4.6 and 2.1 million. So we're going to recognize revenue of 5,321,000 minus 4,000,006. We're going to recognize revenue gross profit of 721,477 in the second year in 2026. And in 2027, we're going to recognize a gross profit of 2 million, of revenue of 2.3 million, more or less, minus 2,100. So just a bit of gross profit. And so we're going to recognize gross profit of 225,581. Now I want you to notice that I have summed all these numbers up. There's the total revenue I've already shown you, summed to 10 million. The total costs incurred during the years as they add up are 8.7 million, which is the same number that I got up here. And then the gross profit is 10,000,003. We're going to recognize in kind of these sort of really rough numbers, but the gross profit is not 10 million, it's 1.3 million. So that's sort of a summary of how the costs have developed over these years now. Okay, now we're going to go on. So we've done the percentage of completion. We've computed the revenue and gross profit to be recognized each year based on the percentage of completion based on costs. Okay, the next part of this is going to be to make the journal entries. And there's going to be basically on a repetitive basis, there's going to be, I'll say on a repetitive basis, there's going to be 4 journal entries. 2 are going to have to do, the first 2 are going to have to do with costs and gross profit. The last 2 are just going to have to do with the billings, which is very easy. They're just accounts receivable and you collect the cash. There's a little trick to it, but it's not bad. And then the final year that you're going to close everything out. Okay, so I like to do these first 2 years first. Okay, and so in the first types anyway. Okay, so the first entry has to do with these are the entries to record. These are the actual construction costs of the project for each one of these years. Okay, and I want you to notice the accounts I'm using. Construction in progress. This is also known as CIP, construction in process. I'm going to go through this a little slowly. Now, you may remember if you took cost accounting or managerial accounting, the account called work in process. You can also call it construction in progress or construction in process. Remember that work in process was an inventory account of unfinished goods on the assembly line. A lot of people consider this, that's why I put this here, to be inventory. This is like an incomplete inventory of a building. The building is 3/4% complete. It's considered inventory. It's kind of analogous to work in process for a construction firm. Okay, some people argue that it is inventory. It's probably a good argument. Okay, so let's start here. So the first thing that we put into construction in process is going to be the actual costs that go in there. So it's think of it as raw materials, labor, and all that that are going into work in process. We're calling construction process now. So these are your actual costs incurred during the year. So we'll just go back up. It's really the first line of this very handy first line. So we incurred $2 million the first year, and then the credits can be cash, accounts payable, anything you want. I mean, so you're paying workers, you're paying on for cash, you're paying vendors, et cetera, et cetera, et cetera, for materials. So this is whatever credit, whoever you're paying, whatever that is. Okay, so we're going to do the same thing for this year. This will be 4.6, I believe. No, I probably moved the line over here. Should be 4.6, and that'll be 4.6. And the last year is your actual costs are 2.1 here. So this is 2,100,000. So that's not too bad. What you're doing is the credits are these are payments that you're making to people, or you're creating accounts payable, whatever. But the important part for our purposes is the construction in progress account, which is like work in process for a manufacturer. It's like partially completed inventory. In this case, it's a building. Okay. Now let's go down. This next entry is very, very, very important. We are going to debit, and I'm going to go ahead and emphasize this construction in progress account, because we are going to debit the same account, construction in process, for the amount of the gross profit that we're going to recognize. And you'll see why I do this at the end. So what we're putting in construction in progress is the actual cost of the project plus the gross profit that you recognize on the project. Okay, so we're going to be debiting that, and we're going to be crediting. We're basically looking at these three for each year, these three numbers right here. Keeping in mind that construction in progress already shows the cost, but we're going to be including in there gross profit. So we're going to be including that number in there. Okay, so what we're going to do here is, and that's the CIP account, and I'm going to emphasize this. This is the same CIP. That's the CIP account. It goes here, CIP, construction in progress, CIP. Okay, it's the same account. So we're putting in there both the cost and the gross profit. And if you think about it, you take your total cost and your total gross profit, it's going to equal your total revenue at the end. Anyway, so we're going to go ahead and debit this gross profit of $352,941. Now, these next two accounts, these are income statement accounts. So I'm going to put here, this goes on your income statement. It's a cost account. I'll show you at the end. This is what I'm adding to what the book does. That's like cost of goods sold. Notice this is like cost of goods sold. So this is like a cost of goods sold, and this is your revenue account that's going to go on your. So this is also an income statement account. This one right here, I'm going to put here. This is going to go on your income statement. So both these accounts get close to retained earnings. So this goes on the income statement. Okay, so construction in progress, we're going to actually put the $2 million into the cost of construction. That's an income statement account. And I want to make sure that I don't have the negative in there. We want negatives in debits and credits. And then the sum of these two, which is really equal to your revenue, but I'll just go ahead and put the revenue in there, but the sum of the two is going to equal the revenue. Okay, so this is going to go into the construction and process account, which is basically it goes into an inventory account. But these two are going to be on your income statement. Your revenue right there, less your cost of goods sold or cost of construction. Same thing basically. Okay. Now we're going to put in for here, we have a gross profit of 721,477. We're going to put in our costs incurred during the year of 4,600,000. I got to change the sign on that. I keep forgetting to change the sign on that there. Okay. And the sum of the two, which we know is your revenue, is 5,321,477. So it's 5,321,477. Okay. Now we come over here and we come to the last year. Okay. The last year, the gross profit for the last year is 225,581, which is right here. Then the costs incurred during the year were 2,100,000, and then we get to the revenue that we recognize at the end, which is 2,325,000. And notice what we've got here. We'll put this as we progress to the job. We will accumulate total revenue of 10 million less the 8,700,000. So we end up with a gross profit that's sitting in construction in progress account of 1,300,000. And I might as well go ahead and add up these numbers up here, the costs here, because I want to show. If you look at the construction in progress account, it has a CIP. It adds up to, at the end, 8,700,000. That's your cost. We've also put in there in the second entry, the second series of entries, 1.3. So the construction in progress account has $10 million in there. So these two accounts are, this one's revenue. That's like, the next one's like your cost of goods sold. So that'll be recognized on the income statement over these years. And then the construction progress account, we will have put in there by the end, $8,700,000 in costs plus gross profit of 1.3. So that's equal to your contract revenue of 10 million. Okay, that's a very important thing there. Okay, now we come to, I'm going to make this 0 down here. Make this 0 so that we see the process. Okay, now we come to the part that's probably the easier part. As you go along, you're going to build a city. You're going to build a city for a total of $10 million. And that comes from the second table that I have here. Let's see if I box this off here. That comes from the second table I have here, which is kind of a second afterthought. But keep in mind that you build a city as you go along. The city has to pay you, or you're not going to be able to pay for all these costs. Most contractors do this. So you're going to build 2 million, 6 million, and 2 million, and then you're going to collect. That adds up to 10 million, by the way. And then you're going to collect it in slightly different format. Amounts of 1.6, 5 million, and 3.4. They both add up to 10 million. Okay, so billings for the year, and what we're going to do is we're going to put that in accounts receivable because we're sending out a bill. Okay, so billings for the year, we'll do this. Billings are 2 million equal to 6 million here, I believe, and then another 2 million. So it goes sort of in the same rhythm as the completion of the job. Most of it's done in 2026. That makes sense. Okay, and of course we'll go ahead and I'll talk about the nature of this journal entry in a second. Okay, so accounts receivable, I think everybody knows what accounts receivable is. Accounts receivable is what's accounts receivable. Now this one right here, billings on contract, this in a sense is considered to be a liability. This is kind of considered to be a liability. And I'll show you what you do with it on the balance sheet at the end. Consider that to be kind of like unearned revenue. You're billing the city for a job you have yet to complete. So you may even bill them. Yeah, I mean, there's just no other way to look at it. I mean, they owe you money, and you're billing the city for a job you have yet to complete. Now, haven't collected cash yet, but you might collect cash. But what we're going to do in the end is we're going to take this liability on the balance sheet and offset it against an asset. But see, that kind of is unearned revenue. It's okay. You kind of finished the building. You're billing them. You haven't collected cash. Maybe that's what the next thing is. But consider that kind of like you owe them the finish of the building. Okay. Now the cash collections, and this is the accounting 001 entry. The cash collections are also from up here. Let's see where, I'll show you where they are. Cash collections are these right here, these numbers right here, which is just debit cash, credit account receivable. Okay, so we're gonna come down here and put those same numbers in here. So here's your cash collections. Just put them here, an equal amount. Let's see, the cash collections are 1.6 million in 25 in the first year. In the second year, they're what did it say, 5 million, I think. 5 million your cash collections here, and then you have 3.4 million are your cash collections in the final year. So here are your cash collections in the final year, 3.4 million. Okay, and I do want to emphasize that, the debits do equal credits, and these add up to 10 million. I also want to emphasize that these accounts receivable and the billings ultimately also add up to $10 million. Okay, now finally, I'm going to put a zero here. And the final entry is, if you go through this whole thing, you'll notice the whole thing is sort of, you have to go look through the whole thing, but the whole thing is sort of cleaned up. But the only two accounts, like cash is cash, accounts receivable were all collected. But you're going to see that the two accounts which have balances in them are one, the construction and process account, and that's why I wanted to emphasize these numbers up here. Construction and process account has all these debits here for the cost of the project, plus these debits here for the gross profit. So you add the two together, you get $10 million. So the construction in progress account has $10 million in there. And the only other account which hasn't been cleaned up, let's say, is the billings in progress account, which you can see from this set of journal entries here has 10 million. So what we're going to do is we're going to just sort of, this is the entry you make when you finish the building. So we're going to go ahead and debit, and I'm just going to go ahead and debit billings in progress for 10 million there. And I'm going to debit credit construction in progress just to clean it up because it's finished now. It's no longer your inventory for that, the cost plus the gross profit. And I'm doing that to emphasize that it consists of both those things. Okay, now so you've kind of recognized revenue and gross profit. The major gist of all this is that you have recognized revenue as the project is completed based on your percentages of completion that you calculated way up here, these percentage of completion there. And you've also recognized gross profit more or less based on those same percentages in a sense. Okay, so now let's go ahead and just see what our financial statements would look like. Okay, now remember what I said, we had an account called revenue on long-term contract. And that's what I was trying to say sort of right here, this account right here. So for 2025, we had revenue on long-term contract of 2.3 million minus the cost of construction. The cost of construction, remember I said it's like cost of goods sold for a construction company minus 2 million. So on our income statement, we're going to have the gross profit 3,52941. That's what we would show. Same thing for 2026. For 2026, we're going to have the costs of revenue on long-term contract of 5,321, and then we're going to take out minus cost of construction right here, 4.6. So that'll give us our gross profit that we recognize of 721,477 that year. There it is. Okay, and then finally, we're going to have in this year, in the final year, you're going to have revenue on long-term contract of 2.3. We already had that. And then we have minus your cost of construction of 2,100,000, excuse me. And that'll give us our final gross profit. On our income statement, formally on our income statement of 225,581. And if you sum these things, they should total up to 1.3 million in gross profit. There it is. Okay, finally we get to the balance sheet. There's only two assets that will sort of track on the balance sheet. The first one is accounts receivable, okay, and that's the easy one because for any one of these years, the accounts receivable is just going to be the debit to accounts receivable minus the collections on account. So you have $400,000 in there at the end of the first year. At the end of the second year, what you do is you take the beginning balance, add your billings, which are a debit of 6 minus your collections of 5. That's going to give you $1,400,000 at the end of the second year. And at the end of the third year, you take your beginning balance plus your billings of 2 million minus your collections of 3,400,000. So you end up with 0. Basically, you've cleaned up the account. The account's clean. You collected all your accounts. Okay, so that gives you 0. Notice that I did use an equation, and it's those 3 items right there. Okay, now the final thing here is, and it could be something very important. There's a rule for this system of accounting, which says that if you have construction in progress, which is like construction in progress is like it's like inventory, and billings are like a liability. So we're really looking at comparing the balance in construction in progress, which is going to include for 225 both the costs and the gross profit. If construction progress exceeds billings, construction progress is an asset. If that's greater than liability and billings, you net the two and you call it a current asset. But if billings is the liability. If billings exceeds the construction progress, you're going to put it in a current liability. In this case, because this is a simple example, I made the example so it construction progress always exceeds billings. Okay, so at the end of 2025, what you have is you have construction in progress of 2 million plus, that's the cost, plus your gross profit, minus your billings on contracts of 2 million, of 2 million right there. So you're going to show an asset of 352,941. Okay, then we come over here, and at the end of the second year, we're going to have a construction in progress account of the beginning. It's like we have that access right there, plus the construction in progress debits that we have of 4.6, plus that number right there, which is your gross profit. And then we're going to take out the billings of $5 million right there. By the way, that should be a minus. Let's see if we get the right number there. Minus, let's do this. That number right there. I think I got to just redo this here because I forgot to put it. It's this number here plus, because it's like an asset, net asset, plus the 4.6 plus the 721. So you have 3 pluses and 1 minus, which is the 877 or I-77 like that, less this 6 right here. So that gives you, I just want to make sure I get everything right here. That gives you a negative 325,581. So this would be a liability. That would be a liability. That would definitely be a liability. And the reason this is a liability, I'm going to go ahead and put this up here. Let me see if I can, it's up here. I'm going to insert a little note here. Oh, I'll just put a note here. This would be a liability, current liability, for 325,581. 325,581 at the end of 2026. At the end of 2026. Now we come to the end of the contract, and we start with that, which is a negative, and we're going to add to that the debits that we had this year for construction in process, plus that's the cost, plus the construction in process for the gross profit, and then minus the billings, and the billings on contract were 2 million. Let's see here. I gotta start again. I made it this far. I want to finish this now. I don't know what happened there. Okay, so this is going to be the beginning balance plus the cost plus the gross profit minus the billings on contracts of these right here, 2 million, which gives you 0. So you end up with a liability asset of 0. Okay, so the example worked out. Okay, and keep in mind what I'm doing with this final 0 there is I started with this negative number, but then I added to that this construction in progress for the costs, the gross profit, and then I took out these billings, and it turned out to be 0, and it should be 0 at the end. So everything is clean at the end. Okay, so the basic aspects to this, the important aspects, are that you recognize revenue and gross profit as the project is complete, okay, as the project is completed, and then you can see the impact on the income statement. I'm going to go ahead and put this up, and I'm going to see if we can have a digital bright space exercise sort of reinforce this. I'm going to change the numbers just to reinforce this. And then, because I know that the CPA exam, they've been tending to have a lot of simulations on this, so you definitely should know how this works. Even if you don't know every detail, have some familiarity of how construction accounting works. And then I may do a second example where they have an expected loss, and then it turned out to be a gain, a final gross profit in the end. There's special rules for that, but it's not very hard. And this example changed. Okay, so I'm going to put this example up, and I will be sending you emails about this. Okay, so this is a very important example. Anyway, I hope everybody has a good night.